Welcome back to the channel. It's Friday, Finance Fridays, and I'm your host, Anthony with InTouch Mortgage Solutions. And this week, we're going to unpack some of these fixed rate mortgages, what's happening right now with fixed rate and variable rate mortgages, especially with the Bank of Canada meeting last week. We've seen some of our banks, some of our lenders, most lenders actually start to adjust some of their rates. Those fixed rate mortgages are coming down. We're going to take a look at where they have been, where they are right now, and what we can anticipate moving forward, especially talking about some of these products that are very specific for many clients who are looking to purchase, either refinance, restructure, switch, or transfer. As many mortgages are going to be approaching renewal, these interest rates couldn't come at a better time for some Canadians, especially as they start to continuously drop. And we're going to be tracking that right here on the channel. Obviously, there are always headwinds that could be facing the Canadian bond market, especially out of the US. But as we start to see things move in the right direction, we can anticipate maybe rate cuts are going to happen at some point in 2024, and obviously that could move fixed rates down even more. So make sure you're subscribed to the channel and you hit that notification bell. But let's get into some of these products right now. Now, there's major differences in some of these particular products depending if you're purchasing, if you're refinancing, or you're looking to switch or transfer into a lower rate mortgage from your existing lender. Now, obviously, there are things that you need to consider when you are leaving your existing lender, what those costs are, and if the rate that you're getting and the cost to get out of that mortgage actually benefit you depending on the length or term of that mortgage. So there are some differences. We'll start with going over what insured mortgages are, just in case you're not aware. An insured mortgage is if you're purchasing a home, it's a for purchase only. It has to be below $1 million. It cannot start with a 25-year amortization. These insured purchases do require you to pay a default mortgage insurance premium because you're putting less than 20% down. And those insurance premiums can range anywhere from 2.8 to 4%. And that is something that you will be adding into your mortgage. You don't have to pay for it up front, but you will pay for it over the course of your mortgage. The only thing that you're paying for on these purchases when it comes to insured mortgages is the taxes, of course. So obviously there are stricter guidelines when it comes to insured mortgages, meaning that you have not only the lender that is approving your deal, but also the insurer. And generally there is no appraisal required. There is an appraisal that is done, but it is not at the cost of the end user, the client themselves. So it's very important to understand that. And this insurance premium is paid to either Sagan, Canada Guarantee, or CMHC, Canadian Mortgage and Housing Corporation. And they are all the same when it comes to their premiums. So that is an insured mortgage. Now, an insurable mortgage is a little bit different. It also applies to switches and transfers. The major distinction between an insurable mortgage is that you do not have to pay the insurance premium yourself. You're not paying that default insurance premium. The lender is usually covering it. Now, rates can range depending on that purchase, or if it's a switch or transfer, depending on the equity or the down payment. If it's, let's say, 20% or more down, up to 35% or more, then you get a slightly better rate. And obviously, these are things that you should be speaking to your mortgage professional about to make sure that you're getting the most accurate and best rate possible, help keep thousands of dollars in your pocket. And a lot of the lenders that we work with on these really good rates, they are basically broker-friendly banks that offer insured and insurable products. Now, there is a switch and transfer component to this, meaning that if you are an existing client with a different lender and you're looking to switch your balance over from that lender to a different lender, no refinance is applicable here. You cannot refinance. It has to be a direct transfer. You're taking the existing balance, switching it over to a different lender, and you are eligible for some of these great rates depending on the equity in your home. So important to understand if you're thinking about switching and transferring. Now, the final product is the conventional product. Now, this one is a very common product for a lot of individuals, maybe in, let's say, Ontario, GTA, Vancouver, BC, because most of those home prices, those purchases are over $1 million. Now, when you buy a home that's over $1 million, you need to have 20%. If conventional mortgages means you can get a 30-year amortization. So a conventional mortgage applies to a refinance equity takeout. If you're looking to pull out some money, maybe consolidate some debts, this is the product that you'd probably be going with, a conventional mortgage. And as I said, there's no cap on the purchase price. You can be at $1 million plus. Now, some lenders have what's called a sliding scale. If the purchase price is over 1.5, 1.6, 1.8 million, you may need to put a little bit more than 20% down, but each lender is different on their criteria and they do change. So some have $2 million caps, plus, right, depending on how much the down payment will be on that particular product. But they are available for clients that are purchasing at that price point. So starting off with those 5-year insured mortgages, some of the most attractive rates that we're going to see online. Obviously, before we get into those exact rates, it's important to understand that not each one of these lenders is identical, right? You may be foregoing or giving up certain criteria in some of these lenders to achieve that better interest rate. And that is a conversation you should be having with your professional. If you're chasing that better rate and you're not concerned with prepayment privileges or particular clauses that are entered into your contract, then you're able to get some of these really good rates. And as I said, this depends from lender to lender. But obviously, if you're looking or chasing some of these prepayment privileges and less penalties or more aggressive penalties on those products, you have to be very cautious on that particular product. Read the fine print, very, very important. So some of these insured products we saw all the way back in September, we're sitting at 5.54%. That has moved all the way down to 4.64% right now for the month of January 2024. And we can see there's a huge runway. We did see them uptick a little bit back in October, and they started making their descent back in November and December as those bond yields continued to go up and down. There was a little bit of bumpy road in there, but they have come down. Then you have your 5-year insured variable rate mortgage. That has pretty much stayed consistent throughout this whole period. We went from prime, which is basically 7.20, minus 1.05%. That's what we call the discount. So you're sitting at around 6.15% for a variable. Key component when you're looking at variable rate mortgage, you have to understand what the differences are. A lot of times we'll have clients that want that variable that's adjustable at this particular point because they believe maybe the Bank of Canada is going to cut rates at one point or at some point in 2024, and they want to make sure that their payments move with the policy rate and the bank's prime lending rate. There's some that are static, meaning whatever you get, that's your payment. Interest and principal calculations will go up or down, but your payment remains the same. And then you have adjustable where that payment will move up and down with the Bank of Canada's policy rate. And that's important to understand, especially when you're selecting a variable. Make sure you know the product. Then you have a 5-year conventional mortgage. That's that 30-year refinance equity takeout product. We saw those around 6.09 at around September, and now we're sitting at 5.59% for a conventional product. We've definitely seen a major swing in these particular rates, and this is really good news for a lot of Canadians. Then the 5-year conventional variable rate mortgage, right? The discount is not as steep as it is for an insured product. And obviously some of these premiums can change depending on the deal, but we're seeing some lenders around prime minus 30, prime minus 40, which puts you around 6.8% on the discount rate. And obviously that's a lot higher than some of these fixed rate mortgages. So making that decision, understanding what your options are, looking at what your timelines are. And obviously another key component with these variable rate mortgages is to understand that most of these variable rate mortgages, at least all the ones that we're talking about, offer a penalty of 3 months. They're all 3 months penalty, interest only to get out of the mortgage. Some of them have a little bit different contracts. Some of them will use what's called the prime rate. They'll go based on the 7.2, and some lenders will use the penalty at the discount rate. So there are differences in these variable rate mortgages. As I mentioned, read the fine print, talk to a mortgage professional to keep thousands of dollars in your pocket. Now, 3-year, very big product. A lot of people selecting the 3-year option because it's giving them that flexibility not to be locked in with a lender for too long, especially if they think interest rates are going to come down continuously. Maybe they're approaching renewal. Maybe they're looking at their options to purchase a 3-year insured mortgage. Started around 6.04 back in September. We've seen it move slowly down to around 5.34% right now. And then a 3-year conventional 6.51 all the way down to 5.55. Now there are some discounts that are available on all these rates depending on the size of the mortgage. For some of our lenders, the larger the mortgage, the bigger the discount, the smaller the mortgage, the closer you're going to get to some of these rates. So it's very important to understand that. And then, you're looking at those 3-year products. There is a new product or a product that we've been talking about over the last little while. It's a 6-month insured mortgage. That's for maybe someone that is looking at the options and saying, hey, maybe I don't want an open product. The open product being much higher interest rates, no penalties to get out, pay it out at any time. But there are some clients that are looking at a 6-month insured product, whether it be a purchase or a switch transfer, and that is 4.49% right now. It's a really good product if you have a short window. These all mortgages that we're talking about here are renewable, right? So in 3 years or 5 years, you're gonna get a renewal notice. You're gonna get that from the lender. They're gonna reach out to you. They're gonna try to get you to lock in for another 1 to 5 years, 7 or 10 years, depending on those options. If it's fixed or variable, you're gonna get a plethora of options, but they're all renewable once you have these options, once you lock in a mortgage. Most of the banks with these particular products, it's important to understand, the major banks, some of these smaller banks, 6 months before that mortgage hits the maturity date, especially at this point in the game where interest rates are, coming down and potentially could be further lower or much lower than what we're seeing here. What's important to really gather is that you can actually renew with the existing lender 6 months before, what's called an early renewal. Now, you don't have to select that option. You can wait to maturity, but with interest rates dropping, a lot of clients want to know what my time horizons are. And generally there's 6 months before you can negotiate to have a new rate issued by that lender. But we always advise to speak to a mortgage professional. If you're using a broker, go back to your broker, have a conversation at renewal time. Even if you're with an equity lender, whatever lender you're with, make sure you have a conversation. It's going to keep more money in your pocket, because sometimes we've noticed a lot of lenders right now, especially the major banks, they might be aggressive on the rates, but not as aggressive as some of these lenders that are looking to get a little bit more of the lion's share of mortgages. Remember, probably 85 to 90% of mortgages are with the major banks. And a lot of these broker-friendly banks that are offering these aggressive rates have some really good products. Some of them have lines of credit, some of them don't. So understanding where you are in that particular product is very important. Now, why is this important? Why are we talking about interest rates? Obviously, for Canadians that are renewing, this is good news. But what about if you're looking to buy? Obviously, these rates right now may not be offered, or probably are not offered with a lot of these lenders on pre-approval. Some of these lenders that offer these rates do not issue pre-approvals. They are just working with live deals. So what we end up doing is getting a pre-approval. The lender will hold that rate. It's a little bit higher than what you're seeing here. But once that deal goes live, what ends up happening is we're able to negotiate that rate down to some of these rates that you've seen, but even lower depending on the size of the mortgage. So that is something that you need to keep in mind. We've had a couple clients that went to major banks, they got a pre-approval, they came to reach out to us. We were able to beat that rate significantly with some of our lenders that we have access to, especially on that mortgage size. So always remember to keep your money in mind, keep those fixed rate mortgages, the variable rate mortgages top of mind, especially if you're renewing or approaching renewal. And if you're looking to get out into the market and get a pre-approval, we always advise you do that just in case the market turns. We start to see fixed rate mortgages go up and able to get into the market with a pre-approval that's going to hold water. Make sure you're providing all that documentation to your broker, to your mortgage professional, so they can review all those items and make sure that your financing can be as tight as possible. Just keep in mind, most of the time they cannot verify that property. So sometimes appraisals are required, and speaking to your mortgage professional about what the options are about getting into a very secure pre-approval can help keep thousands of dollars in your pocket. But we'll leave the video here. Wishing everyone a wonderful Friday. If you have any questions or comments, leave them down below. Let us know your thoughts, and we'll see you next time. We'll see you next week. Have a great weekend.